Good day to all. Today we're going to discuss about completing the tests in the sales and collection cycle with respect to accounts receivable. Make sure that you have watched already the previously released video about sales and collection cycle, although pertaining to tests of controls and substantive tests of transactions. Let's begin. In this particular chapter, we have objectives relating to methodologies for designing tests of details of balances using the audit risk model. We have to take note that in substantive test of transactions, we can do the TDB, wherein we can determine as to how the ending balances of certain accounts are derived at, and accounts receivable is no exception. Then the audit risk model will be discussing and reviewing actually about whether certain accounts, like accounts receivable, are riskier compared with the others. And therefore, we have to gather more evidences for that. Anyhow, these are the balance related audit objectives for AR or accounts receivable. So this has been discussed already in various auditing theory subjects, but allow us to have a review existence or occurrence to check if AR really has occurred for that period or whatever has been recorded has really occurred. Completeness is that whatever accounts receivable or the accounts are occurring or have occurred or existed, they actually are recorded. Accuracy with respect to the amount. Classification is it's going to depend upon the company's policies though, but normally the classification would be in terms of the due dates for collection. So for example, if it is a policy of like 30 days, let's just say range. So we will have, for example, due dates of 1 to 30 days, then 31 to 60, 61 to 90, and so on and so forth. Cutoff is or with respect to the accounting period that we are talking about. Let's just say monthly. So the end of the month is the cutoff date. Realizable value is, of course, known as net realizable value, which is the value of accounts receivable less the valuation allowance, which is the allowance for uncollectible accounts. Since AR are assets, so we have to make sure that we have the rights over them, because we also have to take note that if the sales are conditional, then we don't have the rights yet to such assets. The detailed tie-in is that whatever is the balance, we have to match that with the details. So just like the TDB, tests of details of balances. Then this is our methodology for deciding the tests of details of balances for AR or TDB again. So in phase one, we have to identify the client business risks. Remember, the riskier the business environment would be, then the more the inherent risk would there be, or the innate risk. And then we also have to check the control risk in the company. But then if it is business risk, so for sure it's going to be the two. And then that's going to lead, for example, to higher inherent and control risks. Therefore, we have to increase the procedures or evidences that we gather. Then also we have to set performance materiality, or the tolerable level of misstatement. So for example, if we set a tolerable misstatement of 100,000 pesos, therefore, let's just say 100,000 and above would be material, and lower to that would be not material. And therefore, any values equal to that and higher would be considered material. Therefore, we have to investigate further on. While lower than that will be considered immaterial, and that is for a practical or economical approach, because we cannot like investigate and audit for everything. Otherwise, we'll not be able to finish the audit process. Then assess control risk for sales and collection cycle, as what I've said a while ago. In phase two, we now have to determine and we have to design and perform our TOC and the STOT for the sales and collections cycle. In phase three, we can do also our analytical procedures, meaning the ratios again, and then We can also, or we will also perform the tests for details of AR balance, so the TDB, to satisfy the balance related objectives. And overall, these will go into the audit procedures that we are going to do with respect to management assertions like existence, occurrence, etc., the sample size, items to select, and then timing. And sampling, of course, we cannot examine again 100% of the population. Otherwise, we will not be able to finish the audit and it will be very costly. And of course, the items to select will be depending upon the sampling method that we are doing. And then the timing is when. Normally, if, for example, the items are really moving, example AR, which is really an affected account because of the movement of sales, timing will be done, or the test will be done close to the end of the reporting period. Okay, so this table will show to us the relationship between sales and AR. So you can see here on our Y axis, or the vertical, we have the accounts receivable balance related audit objectives. So if you can notice, the audit objectives also are geared towards, or also termed as, our management assertion. So these are the representations of the management as well as our evidences. So please be guided by the terms. Then occurrence down to timing. For the sales, we have the translation related audit objectives. So we have here the detail tie-in down to rights. Normally, we have common items, but then which items are new, somehow new to us? Probably the detail tie-in. But then again, as what we've said, this is when our details of the accounts are being connected to our ending balances, or the ending, and vice versa. Okay, so we can see here the check marks in red, which would indicate that they are the same. So example, for AR, if we have occurrence, that is existence for AR and sales respectively. Completeness, check. Accuracy, check. Posting and summarization. So posting the details, or transferring the details from the journal to the ledger, and then summarization in the trial balance to financial statements. So check also. Classification, check. Timing, check. If you can notice, AR, of course, will not have the occurrence, although they have the same meaning as existence. Now, this can get confusing though, because I mentioned a while ago that here on the vertical orientation, we have the AR. Well, it looks as if like that, but then if we are going to analyze because of realizable value here, so these parts here actually are belonging to AR, while these items here belong to sales. Sales were discussed in the previous chapter. So if you can recall, that's why these are the terms that we have known there. But then for AR, these are the terms here that we have known in the previous slides. Okay, so we will revise whatever we have said accordingly because we were not clear then. Anyhow, so let's proceed or continue. For AR, so if you can notice, guys, it's the same here as well. And then for the cash receipts, so we have it here, translation related audit objectives. Also, guys, we would not be confused, because if you are going to think about it, these items here are close to cash receipts, translation related audit objectives, and these items here are close to AR balance. Therefore, they are there respectively. Then what is somehow like shocking here, so if we can see it, guys, is that occurrence here should have been on existence, and completeness should have been on completeness. Do you follow? So we can revise the arrow, then accuracy, posting, detail type, and classification, and timing or cut off. So We just have to revise that as well. And now revised. Next objective, design and perform analytical procedures or AP for accounts in the sales and collection cycle. As what we've said, we are going to look into the ratios. So these ratios are not actually new to us. Example would be gross margin percentage, which is our gross profit or margin or income divided by sales. Normally, that's going to be constant unless there has been some changes on the costs and prices. Take note, it's an or, because if the change is same and then what has been added is the same, so that's going to have gross margin constant. There would be a red flag if in case there has been no change, but then the gross margin was incorrect or different from the previous years or the trend. Then we compare by product line, by the way, so different products of organizations being offered. Then sales by month over time. So we will know if ever certain months have greater or lower sales than the rest or others, especially for seasonal products. Then sales returns and allowances as a percentage of gross sales with previous years. So we will know also the trend or pattern. Are we increasing? Are we decreasing? And we will be able to know what would be or what are the causes of such. Then we also have to know individual customer balances over a stated amount. So ending balance of AR with respect to the total value, for example, and we will know what percent has been collected already. Based also on experience, we will know that are we improving or what happened? Why is it that our percentages of collections are lower than the previous years or higher? Then bad debt expense as a percentage of gross sales. Normally, if we use percentage of sales, then as our method for the expense. Unless if we are using again IFRS based methods like aging of accounts receivable or the matrix method, which is the most favored, followed by percentages of accounts receivable, wherein whatever will be the ending balance of that will be the ending balance of the allowance as well, and we squeeze the expense. Then the DSO or the days of sales outstanding, so that we will know like how many days wherein the accounts receivable are still there. And sales, of course, that's different. For AR, that's the age of accounts receivable. We'll know like how many days would the accounts receivable be collected. Then we also need to mention aging, discussed already, the allowance as percentage of AR, and the write-off also, but now as a percentage of AR. This has been discussed in the previous chapter as well. Now we have here the selected comparative information with certain items on the financial statements. Then we can notice here the percentages of changes. So from 2011 ending to 2012, we will get the percentage of change, as well as from 2012 ending to 2013 ending. So how do we get the percentage of change? Just a trivia. So that is to get the difference of the two. So the current year, let's assume 2012, minus past year or base year, that's another term. And then whatever is the difference, we divide that by the base year. So that is really the formula. And then that's positive because there has been an increase. Here it increased further. So this will be our current year and this will be our base year. We get the difference. We divide that by our base year and we get now the percentage of change. Then we get the following values for Hillsburg Hardware Company sales and collection cycle with respect to the trend or pattern. And then we notice that there has been changes on the gross margin or net sales. Probably this is because of some returns and allowances, and we will never know if there are also discounts. But we can notice that the changes, for example, for gross margin is just a matter of point 0 something in percent. So that's going to be okay or fine though. So we can notice that All items are with our respective ranges from 2011. Exception would be, you can notice that the net accounts receivable over total current assets, the movement is at 5 or 4 point something percentage. Then allowance, so increase from 2011 to 2012 and then decrease to 2013. So in that case, the allowances became lower by 2013, probably because we have been able to collect, we have improved our collection policies. We have to take note that number of days receivables outstanding and economic conditions do not justify this change of the allowance. And then potential misstatement is approximately from the amount of our accounts receivable, and we get the difference between this 0.064 and 0.01. So for the 2 years ending 2011 to 2013, so we get the statement of $60,000. Take note that's potential, not necessarily like actual. Next to that would be the TDB in the phase 3. We have to take note that the detection risk being the residual risk in the audit risk model after inherent risk and control risk. So that is a matter of the auditor's decision, but based, of course, on the given inherent risk and control risk. And combining those factors with the audit risk model. So example, with audit acceptable or applicable risk at 10%, given an inherent risk of 100 and control risk of, let's say, 90%. So we get the balance of the plan detection risk. So that plan detection risk will be our basis as to how extensive our test of details of AR balances would be. And we combine the factors that determine plan detection risk, which is somehow complex. Next, design and perform the tests. So for AR, we have to make sure that they're correctly added and agreed with the master file and the general ledger, the aged trial balance. Again, the aged trial balance will show to us the days outstanding of the accounts receivable. And then normally we multiply that with the percentages uncollectible. We get the total. That's the ending balance of the allowance, also known as the matrix trial balance under the aging of AR or matrix method. So normally the general ledger file will be agreeing, of course, to the master file, which is our AR master file. When summarized, the subsidiary ledgers actually will be getting the schedule of accounts receivable. Then we have to check the existence and the completeness. Existence, of course, or occurrence, whether what has been recorded actually existed and whatever has existed actually are included. Then we also have to make sure that the values are correct, proper classification, cutoff. Actually, this has been mentioned already. This is the realizable value, then rights and presentation and disclosure. For presentation, well, for accounts receivable, normally they are within the normal operating cycle, therefore current. Disclosure, we have to make sure though, because it's possible that accounts receivable could be pledged, in which we have to disclose that. Pledging, meaning it is being used for the accounts receivable, no specific one has been used as a collateral for loans. But then if there is really a specific AR that has been assigned, you call that assignment. So let's say the AR coming from this company has been used as a collateral specifically for a certain loan. So it requires us to have a journal entry. We have to transfer from AR general, we credit that and we debit AR assigned or AR accounts receivable dash assigned. So that would require a journal entry and a disclosure on the notes as well. For objective 4, we obtain and evaluate accounts receivable confirmations. So we are going to check if what is being recorded on the reports of our clients actually are same as what the customers reflected. So just for us to verify the values. In United States, required, except when. So if low response rate, because in confirmation, it's possible that we will have to use positive confirmation that we need a response. So if low response rate, we think otherwise. Low inherent and control risk, so the business is not that risky, therefore we do not need to confirm. For the first one, low response rate, we can do alternate procedures like the negative confirmation. If they do not respond within a certain period, it's assumed that the balance is correct. So that's it. But for international auditing standards, or IAS here, but then actually it's international standards on auditing, or ISAs. So confirmations are not required. Anyway, positive, as said, blank. So the client has to put the balance, or the customer, the client of our client, by the way, because we're the auditors here. Invoice confirmation. So the details of the invoice. A negative, wherein just the balance of the AR, and then if they do not respond within a certain period of time, the balance is assumed to be correct. Positive confirmation, here is an example. So for example, the balance here is correct, except as noted below. Really, there is a certain part here that we need a response, and this has to be returned by our customers, or the client's customers. But then if, for example, there's low response rate, we cannot do this. Negative confirmation requirements if the risk of material misstatement is low. So low risks in the company, low chances or opportunities to have misstatements which are material. There's an emphasis of material once again, since in audit we focus on material items. Then large number of small account balances. So there are many items or invoices or clients, or the customers of the client or clients, but they have small account balances. So they're not that material to the overall balance of AR. So we can do negative. Otherwise, if the values really are material to the overall AR, we will have to use positive confirmation. Expected low exception rate. So in a population, it's possible really that there will be deviations on our estimates. For example, if we do sampling, so it's possible really that we have, or what we actually obtain are not actual representatives of the population. So in that case, we have to consider only the items that would be material to the accounts receivable population. In addition to that, it's really possible that what we obtained would not be representatives of such, and those are the exceptions. So if the exceptions rate, or the risks of not getting the desired samples from the population would be low, so we'd use negative confirmation. And then expect adequate consideration from recipients. Okay, so of course they will not have to reply, they're not required to reply, and we assume that such would be correct. So example here, please examine the statement carefully. If it does not agree with your records, please report any exceptions directly to our auditors. And then do not send your remittance to our auditors. So just to confirm that this is checking the balance. So no remittance. This is not asking for any payment, just confirmation of the balance. Timing. The most reliable evidence from confirmations is obtained when they are sent as close to the balance sheet date as possible. As said a while ago, the accounts receivable normally are moving items. They are variable, and they are easily changing from one day to another. That's why if we are going to perform tests like confirmations, they have to be close to the reporting date or balance sheet date. Then for sampling, especially getting the size, we have to check the following items. Is the account really risky? So if that's the case, we need more samples. If really more in terms of risks or riskier. as well as the control risk. If the internal controls present with respect to sales and accounts receivable are not strong, so we have to perform more procedures, especially for the sampling, we need to sample more. Then if the type of confirmation would be positive, so it's going to depend as well, or negative. For positive, normally these are, or the positive confirmation would deal with these accounts receivable balances that are bigger but normally few. So therefore, if few items, size would be small. But for the negative, population is big, therefore the size would be lower. Then achieved detection risk from other tests. This would also affect, if our detection risk would be lower, normally we are going to get lesser samples then. So lesser evidences, because we can actually detect the items with greater or material misstatements. If we get, for example, lesser samples from other tests, so we will be performing more in the remaining tests. For example, this is one of the remaining tests. Then performance materiality, or the tolerable misstatement, if we have higher amount of misstatement that we can tolerate, then we are going to have lesser samples. Okay, what about the verification of addresses and maintaining control? Before we send any confirmation, it must be that the addresses or email addresses also has been verified, so that you have to ensure that we'll be getting something out of the confirmations that we have made. Then take note that because the auditors will be the ones to make the confirmations, therefore they are responsible for mailing and maintaining control until they are returned from the customer, not our clients. Then follow up on non-responses. That's really possible. For positive confirmations, we said if there is higher response rate, but we have to follow up, especially for this. Auditing standards require follow-up. Procedures for confirmations not returned by the customers would be as follows. So subsequent cash receipts. For example, if no response coming from the customer, so we will check like for the following days or weeks or months, what are the cash receipts received coming from the customer or such customer. So that can be also used as basis for the balances of AR, just to check. So example, balance of November, and then there are some collections in December, we can verify. Then duplicate sales invoices, yes. Remember when we deliver the goods to our clients and we already got their delivery receipt signed, because they have received the goods in original condition. So the duplicate sales invoices are kept by us, the duplicate copies, and we can verify, so that we will know the amount of accounts receivable less the collections already made by the customers out of the official receipts, and we get the balance of accounts receivable, as well as the shipping documents or the bill of lading as evidence of shipments. So we can make use of the three. Then for the differences, it's possible that there could be payment in transit, meaning payment that is actually still floating. When we say floating, it's not yet reflected in the records of the business. It's possible it has been recorded in the bank, but not yet in the books of the company. So if we check real time with the bank, it's possible that it's there. Then shipment in transit. So the goods are still in the ship or on the ship, for example, and then still to be delivered. So on the seas, and we'll have to check the FOB shipping terms for us to know like who owns such. And then if the sale already is applicable, the revenue should be recorded. And then in that case, so sale is to be considered an accounts receivable. So that's also one thing that we have to take note. If goods have been returned, it's possible that there are returns. So that's why there are differences already of the AR that was presented by the client as well as what we have computed. And errors and disputes of the amounts. There could be errors like really intentional errors or unintentional, depends. And disputes like disagreements as to the recognition. For conclusions, we can reevaluate the internal control, and then qualitative nature of misstatements. It's possible that the amounts would be lower. So immaterial because they are below the threshold or the performance materiality or the tolerable level of misstatement, but then they have to be evaluated just in case. And then determine whether sufficient in terms of quantity and the quality of the evidence here, qualitative, was obtained so that our evidences gathered would be persuasive or convincing. Then we also design audit procedures for the audit of accounts receivable using an evidence planning worksheet as a guide. So this is a helpful table, but you have to be vigilant, or you have to be very open-minded with this table because it's not that friendly to look at. So here, for the evidence planning worksheet, we can notice here on the side for vertical parts, we have certain items on risks and tests that we do. Then these are the transaction-related audit objectives that we have known. So detail tie-in down to rights. If we have an acceptable audit risk, so we will be will be getting medium evidence out of data tie-in and so on down to rights. For inherent risk, so just low, existence medium, and so on. So this would be our guide. So by just having low completeness, then we'll be able to address the needs for inherent risk. And then, and so on and so forth. Allow me to look into items with not applicable. Control risk for sales. So internal controls present for sales, the policies, procedures, rights are not applicable. So not necessarily, and it's not making sense at all. Rights are, of course, having the potentials of economic benefits of such accounts. Then the control for cash receipts not applicable for realizable value because cash receipts are not presented at that, as well as the rights. Normally, rights are on the ending balances and on assets. Sales are not assets. Then control risk, additional controls, none for these items, but for the rights, low. What about for substantive tests of transactions for sales and we do detail tie-in? So that would achieve good results. Just to check classification, that would get or that would result to good results. So we look into the transactions. So we do, for example, recalculation, reperformance, and we will get the good results. You can also notice here unacceptable results for substantive tests of transactions for sales. Quite a word, quite a term, so very mouthy. And then cut off, that is unacceptable for such. The question could be why? Because for substantive tests of transactions, we do the very exhaustive details. We get the details. So if we would like to get cut off, normally we determine the balance or we get close to the balance. All right. So for analytical procedures, unacceptable for realizable value because we do not use the ratios for that. And then for the rights, it's not applicable. So use ratios to establish rights, not making sense at all. All right. So those are just some items that we can learn from evidence planning worksheet. Hopefully you've learned something from this session. Thank you very much. See you in another video and learning session, and God bless us all.